Good morning, ladies and gentlemen. Well, the speed dial improved throughout the week. We started off very weak and we finished quite strong, although still in negative territory, but very close to zero. So we started at minus 51 and we ended at minus 15. Overall, a risk-on week throughout. We bounced out of the deviations green zone, and we had the counter trend model long for the first 3 days of the week. As you can see here, it marked the absolute low, and then the market recovered. The question then becomes, what now? If we have a look at the deviations, we will see how the market bounced straight out of the red zone. If we go back up to SPY, we'll see it even better. A bounce straight out of this green zone and straight back up to the middle line. The question now becomes, what can we expect? And probably we should be expecting some more bounces towards the red zone. I don't think the market can make it into the red zone, but we have a variety of gaps up here which at some stage will be filled. The very weak numbers for non-farm payroll on Friday have put a Fed rate cut back on the table. I think it's more likely than not that we retrace some of the euphoria we've had in the short end, probably getting to 195 to 2 as a normal retracement of this very sharp move. The market is now discounting 1.5 rate cuts, and it would be normal that the market over the course of the next few days tries to give up some of those gains. I would have thought the ideal place to get back into the 2-year would be around 2, between 195 and 2, and that is where I think I shall put my position back to full size. If we look at the Bund, we will see that it's gone straight through the minus 16 level, which is so important, and it's gone all the way to minus 25. Bunds are becoming very difficult to trade simply because of the scarcity value of the Bund. I think at some stage we will trade back up to minus 16, and minus 16 is going to become a swing level, just like 8 basis points up here was. 8 basis points to me is still the as important a swing level as you can have. It's going to be the dividing line between a bear market in bonds and a bull market in bonds. Minus 16, I would have thought would be an oversold bounce, and probably another chance to do some options and look for even lower yields. On a relative basis, Bunds versus the 10-year, I would have thought that retesting this line is reasonable. Minus 241 to minus 245. If we can't get below minus 245, then I would expect another wave down towards minus 200 basis points or 210 basis points. That is going to be, to me, where we are eventually going. The implication for the dollar are that we see a bounce now from the 96.50 level, but we will we'll look at that in much more detail now. To me, this chart is now becoming all important because we are at the crossroad in the United States dollar. 96.50 has been achieved, and that is the level that is going to be the really important swing from now on. If I enlarge it, we can see how important it is. It's the 200-day moving average. It's the level that has held and made the swing for such a long time, for years and years and years, and we're very close to this very important trend line. Not that I, give that much credence to a trend line. What we are is very oversold. We are through the Bollinger Bands, and now if we get a bounce, which I would expect, but this bounce goes no higher than 97.52, that will give us the impetus and the momentum to break down through this 96.50 level. I do not expect this break through 96.50 to occur this next week. I expect this next week to be a retracement week towards 97.52. And once that happens, that will be the true test of what is likely to happen over the course of the next several months. If we really cannot break through 97.52 again, the market is saying that it's very heavy and that it's going to take any and all opportunities to break through 96.50. Once that happens, we have nothing until 95.07. Is going to be a very quick move, and through 95.07, which I don't think it will hold. If then we are looking at 92.50 and that kind of range. It's going to be a very violent move, and to me that implies that at some stage the Fed will cut and the Fed will take rates way towards zero. Why that's going to happen, I have no idea, and cannot have an idea now. But to me now we are at a true crossroads. The market, if it cannot take out 97.52, which would imply complete normality and that the figures we saw on Friday were an aberration, that would mean probably a recessionary start in the States, and the Fed throwing the kitchen sink at the problem, and having a huge move in 2 years, having a huge move in the dollar index, and having a huge move in all bonds. Well, last week we achieved the first of our objectives in the 5-year, which was around the 186 level. It would be normal now to have some sort of a bounce and filling these gaps just above 2, maybe going all the way up to 210, 213. I really don't think 213 gets broken. If we see that over the course of the next 1 or 2 weeks, without the dollar breaking through those levels that I've just shown you, then that is a fantastic risk reward level to look for lower yields and the market to come all the way down to 161. But I think next week is likely to be a continuation of some sort of risk on, and therefore backing up of yields as they have come an awful long way, and it would be normal for people to take profits. Much the same picture in 10 years. It achieved within a hair's breadth of getting to 2, and now if we were to go to I don't know, 220 or so, but I would have thought more realistically, 221, something like that. That would be more or less the realistic level to put back on longs in the bonds. I think they will squeeze people, that will not make it so easy that you can stay in your long bond position. So around the 221 level is what I expect that we trade next week during a risk on phase. If we look at TLT, well, last week we touched 132.08 and we just could not stay above it. We are above the weekly Bollinger Bands. That to me tells me that at some stage we trade back down towards 127.37, get support there, and then squeeze higher, probably all the way to 137. That kind of move, implying that the next week is going to be one of probably dollar strength, yield strength, i.e. futures weakness in bonds, and risk on move with some strength in the stock markets. Personally, I was quite surprised by the strength in ES last week. The first part of the week was easy. The move back up to 2800 was what you could easily expect. But the second move through 2800 and above 2864 was very, very impressive. The market got caught very short. I would have thought now it is more likely than not that we will try and fill these gaps that we have first around the 2905 area and then later all the way to 2950. There is no way that we do not trade at least 2 or 3 weeks above 2864 now that we've broken it. I would have thought 2864 is going to be very hard to break back on the downside. To me, a 2 to 3 week range between the low that we made on the close from Friday, RE 2873, 2864, all the way back up towards 2954, get some people really bullsed up and then come back down. That is the kind of range that I'm seeing for the next 2 or 3 weeks, i.e. higher from here, lower futures prices in bonds, and hopefully a higher dollar that gives us a clue as to where the next big move is going to come from in the dollar. On a daily basis, if we look at the SPX, you can see the top of the Bollinger Bands coming around 2903. It'll open up a little bit. So I would have thought the top is going to be somewhere around Wednesday, Thursday, around 2920, 2930, that kind of thing. And that will open up the downside again to test the levels that, that the longs have. These moving averages are coming back up. And I would have thought 2864 from now on is going to be tough to break on the downside, especially if the market can sustain 2900 over the course of the first few days of the week. I want you to be aware of the enormous difference in values between the industrials on the right and the transports on the left. The transports have a descending 200-day moving average, are much, much weaker than the Dow Jones Industrial. I would have thought it's quite unlikely that the transports do very much better over the course of the next week or so than 10,500-ish. And while the Dow Jones pushes up towards the 26,500, this sets up quite a big divergence between the two sectors, which at some stage will be resolved. But what that tells me is that we are not going to go and make new highs on the Dow just that easily. I think it's going to take a lot more trading in June and July before we get a resolution to this dichotomy: who is right, the industrials or the transports. Throughout this latest move down and in SPX, when we touch the levels in around 2737, which, I said would be the bottom. I was quite lucky there. Volatility was the dog that didn't bark. The fact that it couldn't even get up above 1964 to me indicated that we were going to get a bounce, and we did. But the fact that now volatility is so sticky also indicates to me that the upside is not that great from these levels. Are we going to fill these gaps down towards 14? Probably. But it just feels like we're now range bound, both in volatility and in the market. I think people who get long above 2920, 2930 are going to suffer the same fate as the people who got short at 2737. To me, this is telling me that the market is going to be in a range for the next few weeks. Gold is looking interesting insofar as it is signaling something coming up. Gold really moves as an inverse to yields, real yields, and moves as an inverse to the dollar. The the real yields and the dollar, I believe, are tied and strengthen and reinforce each other in the price of gold. This is a weekly chart, and we touched the top of the Bollinger Band and slightly backed off. It would not surprise me, and this is actually reinforcing my view that I stated earlier about what's going to happen to the dollar and to yields, if we have 3 or 4 weeks of basically bull flagging on the weeklies, simply because we probably need to come back down and retest close to 13.12, 13.15, that kind of level. If we move on to a daily chart, we will see how overbought we are here. We are through all these Bollinger Bands. It would be normal if we took a few days to come back down towards the 13.11 level, let all these moving averages turn, and then we will, correct all these ridiculous RSIs and very high stochastics, and then we could go again. So it all falls into place. At a few days of dollar strength, a few days of yield strength in the States, a few more risk-on days where the S&P continues to fill those gaps that we have above all the way up to 2950, but cannot break it. That is the kind of scenario that we have for the next week, probably even two. And with that, we have the biases. I really think the clearest level is here at 213 in the 5 years. While we're below that, any attempt to go back towards it is just a dead cat bounce. Not that it's not going to happen, I think it probably will do, but I don't see the market going through 213. And that level basically in the 10-year note is 233. So while the market is below 213 and 233, the primary trend is still down in yield. 217 is now too high in the 2-year note. I think if the market has, and it should continue to expect rate cuts from the Fed, for the market not to continue to expect rate cuts from the Fed, we need some strong data out of the States that negates the weak data we've had this week. So to me, if we go back up towards 2, I would say that the level becomes now 2 in the 2-year note. That will be the level that I'm happy to reinstate my full position in the 2-year note, and the 2-year note is going to continue to have optionality from that kind of level. Bunds and bobble, I don't know what to tell you. It's just complete scarcity. You can't be short of Bund futures simply because you don't know where they could go to any price, because there aren't any Bunds to be traded. So minus 16 is going to be a level where it pays to get long of some calls again. As I said, for the SPX, the really important level, all these levels are now out of the question. 2864 is again the very important level. Why it stays above, and I expect it to stay above. We will make attempts to fill all these gaps up to 2950 and get people bullish and wrong up there again. I think we're in a range. I think 2950 is as high as you are likely to get, and then eventually at some stage the market will tell us what we need to do. I would leave NQ completely alone. It's going to outperform certainly on the upside, but it's also going to outperform on the downside. It's not something that I would trade at the moment at all. I was right, below 7,000 it's a buy, but it's an opportunistic buy. I just don't think we're in the same kind of scenario as we were earlier in the year, when you can buy NQ and forget it. We're just not in that kind of scenario. DXY is the really interesting one, and it's the one that's going to make us real money in the next 6 months, call it. If we can't go any higher than 97.25, then that is the tell that at some stage we'll break 96.50. But I don't expect that to happen next week. Certainly not the break to the downside. As soon as we get the break of 96.50, that is the moment to go to the long straddle and activate that strategy, because the move to the downside, I think, is going to be very violent. Thank you very much indeed, and tweet you on Monday.